Welcome to the deep dive. You've sent over some really focused materials this time.
Yeah, it looks like we're zoning in on auditing accounting estimates.
Exactly, and the related disclosures. Specifically, ISA 540 keeps popping up.
Right. That's the main standard for this area.
So our mission here, for you listening, is to really pull apart this standard, get to the core stuff.
Yep. We want to give you the actionable bits, the must-know insights from these sources you shared.
Without drowning you in textbook language, let's aim for clarity and, well, efficiency.
Sounds like a plan. Consider this your focus briefing on ISA 540 and estimates. We'll hit the critical points.
Okay, let's jump right in then. ISA 540, it's all about the auditor's job when they encounter accounting estimates during a financial statement audit.
Yeah, that's the gist of it.
Now, for folks maybe not deep in this daily, what exactly are accounting estimates? It sounds a bit vague.
It can seem that way. The standard defines them as basically money amounts into the financials where there's measurement uncertainty.
Measurement uncertainty, meaning you can't just, count it.
Exactly. You can't pin down the exact number precisely at the reporting date. There's some estimation involved, some judgment.
Okay, so not like counting cash in the till. Can you give us some common examples from the materials?
Sure. The classics are things like the allowance for doubtful accounts,
Hmm.
estimating how many customers won't pay up,
Ah, right. That's definitely an estimate.
or inventory obsolescence, guessing how much stock will become worthless. Depreciation is another big one. Warranty obligations, too.
Gotcha. So things that rely on future predictions or judgments about current conditions.
Precisely. They all need management to make assumptions based on the best info they have at the time.
And because they aren't exact figures, ISA 540 gives auditors the rule book on how to handle them. What's the main goal for the auditor here?
The big objective: get enough good evidence, sufficient appropriate audit evidence, in auditor speak, to decide if these estimates are reasonable.
Reasonable in context.
Yes, reasonable within the rules of whatever financial reporting framework they're using. And that includes the disclosures, the explanations around the numbers. They can't just nod them through.
Right, and need to kick the tires a bit. So where does this whole process start for the auditor?
It really kicks off with understanding the company and its world, its environment.
Knowing the business context.
Absolutely. You need that foundation to spot where the risks might be hiding, specifically for these estimates. Things like the industry, regulations, the very nature of the business.
Yeah.
It all matters.
So a tech startup estimating software development value versus a mining company estimating resource reserve, very different worlds, different risks.
Totally different.
Yeah.
And part of that understanding is digging into what the standard calls inherent risk factors.
Inherent risk factors, what are those?
These are the characteristics of the estimate itself that make it risky, even before you think about the company's controls.
Okay, what kind of characteristics?
Well, complexity is a big one. If the calculation is super complicated, lots of moving parts, the chance of error goes up.
Makes sense.
Subjectivity is another. How much does it rely on management's judgment about the future? More judgment often means, well, more wiggle room, potentially more risk.
And more uncertainty.
Yeah, plain old uncertainty. If the future factors influencing the estimate are really unpredictable, the inherent risk is naturally higher. Think long-term provisions versus short-term accruals.
Right. Now, the materials also mention something. Management bias. That sounds important.
It's crucial. This is about whether management is neutral when making these estimates,
neutral.
as opposed to,
As opposed to having some sort of bias, maybe wanting the results to look better, It could be intentional, trying to smooth earnings, or unintentional, just being overly optimistic.
So the auditor has to watch out for that slant.
Definitely. They need to be alert for signs of potential bias because it can really skew the estimates. Okay, so the auditor understands the business, assesses these inherent risks, watches for bias. What then? How do they actually respond?
That leads them to design and perform further audit procedures. Basically, specific audit tests.
Tailored tests.
Yes, tailored to tackle the risks they identified for each key estimate at the assertion level.
Assertion level, meaning
Meaning the claims management is making about the estimate in the financials. Like, is it complete? Is it accurate? Is it valued correctly?
got it. So targeted responses. What do these responses look like? What kind of procedures are we talking about?
The material highlights a few main ways. One common one is testing how management made the estimate.
Looking under the hood of their process.
Exactly. Understanding their method, checking the data they use, was it reliable, and really scrutinizing the big assumptions they made.
So kind of rerunning the numbers, metaphorically speaking.
In a way, yes. or at least understanding the logic and inputs thoroughly. Another approach is for the auditor to develop their own independent estimate.
Like come up with their own number.
Yeah, or maybe a range. They calculate what they think is reasonable based on their understanding and evidence. Then they compare it to management's number.
That sounds like a good way to get an objective check. Any other common tactics?
Reviewing subsequent events is another one. Things that happen after the year end but before the audit report is signed off.
How does that help?
Well, sometimes those later events give you really good evidence about an estimate made earlier, say a big lawsuit estimate. If it settles right after year end, the settlement amount tells you a lot about how reasonable the original estimate was.
Ah, using hindsight, essentially. Okay. And through all this testing, what's the constant focus regarding management's input?
A key focus is always, are management's assumptions reasonable? Are they consistent? Do they make sense given everything else we know about the company and the market?
And consistent over time, too.
Yes, consistency is important. Arbitrary changes in assumptions raise red flags.
Okay, we've covered understanding risks, responding with tests. What's the next step after gathering all this evidence?
Then comes the evaluation stage. The auditor pulls together everything they found, all the evidence,
And decides.
and decides whether the estimates in the financials and the disclosures explaining them are reasonable overall, considering the accounting rules, of course.
And I guess that management bias concern pops up again here.
Absolutely. Even when evaluating the final numbers, the auditor has to stay skeptical. Keep an eye out for indicators of bias.
So even if the number itself seems okay, if the process felt biased.
That matters. It affects the auditor's overall conclusion about the estimate's reasonableness. It's not just the final number, it's the whole picture.
Right. Now, we talked a lot about the numbers, the estimates themselves, but the outline stress disclosures too. Why are they so critical?
Because the number alone doesn't tell the whole story, especially with estimates. Users of the financial statement, investors, lenders need to understand how that number was derived.
What went into it?
Exactly. What were the key assumptions? What are the major uncertainties or sensitivities? Good disclosures explain that. They're required by the accounting standards for a reason.
To help people make informed decisions.
Precisely.
And the auditor's role with these disclosures.
They have to evaluate them. Are they adequate? Are they clear?
Uh,
Understandable.
and if they're not?
If the auditor thinks the disclosures about a really important estimate are inadequate, maybe they don't explain the risks clearly or hide key assumptions, that's a problem.
A big problem.
It can be. As the material notes, ISA 705 deals with this. It could affect the auditor's opinion, might lead to a qualified opinion, or even an adverse one in serious cases. It signals that the reporting isn't fully transparent.
Wow. So weak disclosure on a key estimate could really taint the whole report.
Okay.
Now, shifting gears slightly, the sources also had appendices on audit sampling. Appendix 3 talks about factors influencing sample size for tests of details. Why is sample size such a big deal?
Well, auditors usually can't check every single transaction, right? It's just too much.
Practical, yeah.
So they use sampling. They pick a representative chunk, test that, and then project the results to the whole population. The size of that chunk, the sample size, is critical.
Needs to be big enough to trust the results.
Exactly. Big enough to give the auditor reasonable confidence that what they find in the sample reflects the whole group. Appendix 3 lays out the key things that drive that size calculation for detailed testing.
Okay, let's quickly run through those factors. First one, the auditor's assessment of the risk of material misstatement. How does that affect sample size?
Simple relationship here. Higher assessed risk means larger sample size needed.
More risk, more testing.
Pretty much. If you think there's a higher chance of significant errors, you need to look at more items to get comfortable.
Makes sense. Second factor, using other substantive procedures for the same assertion. How does that play in?
This one works the other way. It's an inverse relationship.
Meaning?
If the auditor is getting good evidence from other tests, like strong analytical procedures, or maybe they've tested controls and found them effective,
They can do less detailed testing.
they might be able to reduce the sample size for the tests of details. The idea is you get assurance from a mix of procedures. If other parts are strong, maybe this part doesn't need to be quite as extensive.
Okay, balancing the evidence sources. Third factor, the auditor's desired level of assurance. Basically, how sure do they want to be?
Higher desired assurance means larger sample size. Again, a direct link.
More certainty requires more looking.
Yep. If you want to be more confident that any errors don't exceed the acceptable limit, you need to examine more items.
Okay. Fourth factor, tolerable misstatement. What's that and what's the impact?
Tolerable misstatement is the maximum error the auditor can accept in that population without it being material.
The error threshold?
Kinda, yeah.
Okay.
And it has an inverse relationship with sample size. If you can tolerate a larger potential error, higher tolerable misstatement, you generally need a smaller sample.
Because you don't need to be quite as precise.
Exactly. If the acceptable margin for error is wider, you don't need as fine-grained a sample.
Got it. Fifth factor. The amount of misstatement the auditor expects to find.
Right, the expected error. If you expect to find more errors based on past experience or initial checks,
You need a bigger sample?
you do. Direct relationship again. Higher expected errors suggests higher risk, so you need a larger sample to reliably estimate the actual error amount.
Okay. Sixth factor. Stratification. What's that?
Stratification means dividing the population into subgroups, strata, based on shared characteristics, like grouping big invoices separately from small ones.
Sorting things out first. How does that help?
It often makes the audit more efficient. You can focus testing on the higher risk or higher value strata, and this can lead to a smaller overall sample size compared to testing the whole population randomly.
So smarter sampling, potentially less volume.
Potentially, yes.
Yeah.
By targeting your efforts.
Okay. And the last factor, number 7. The number of sampling units in the population. The total size of the group being tested.
This one's interesting. For large populations, which is common in audits,
Yeah.
the actual size of the population has very little effect on the sample size.
Really? So going from 10,000 items to 20,000 doesn't double the sample?
Nope, not significantly. The sample size is driven much more by the risk, the assurance level, the tolerable and expected errors we just talked about. Once the population is reasonably large, adding more items doesn't really move the needle on the required sample size much.
Huh. That's counterintuitive but important. Okay, that covers factors influencing size. Appendix 4 then lists different ways to select the sample. Can we touch on those briefly?
Sure, there are several main methods.
Mhm.
Random selection is, well, random. Every item has an equal chance of being picked. Usually done with software, random number generators.
The purest form maybe minimizes bias?
Theoretically, yes.
Right.
Then there's systematic selection.
How does that work?
You pick a random starting point, then select every nth item, like every 50th invoice. It's efficient, but you have to watch out for weird patterns in the data that might line up with your interval.
Right, could accidentally get a skewed sample if there's a cycle. What's next?
Monetary unit sampling, or MUS. This is value weighted.
Value weighted.
Yeah. Each dollar is treated as a potential sampling unit. So larger dollar items have a much higher chance of being selected. Great for things like accounts receivable, where you're focused on overstatement risk in big balances.
Focuses the effort on the big bucks.
Okay. Then there's haphazard selection. Sounds a bit iffy.
It is less structured. The auditor picks items without a formal technique, but tries not to be biased.
Cries.
Yeah. The standard warns this isn't suitable for statistical sampling because you can't mathematically prove its randomness. Fine for some non-statistical tests, perhaps, but needs care.
Right. Hard to guarantee you weren't subconsciously picking certain things. What's the last one? Block selection?
Block selection is just picking a chunk of consecutive items, like all transactions from the first week of March.
Simple, but
Generally not good. The standard basically says don't do it unless you have no other choice. A single block is rarely representative of the whole period. That week might have been unusual. Makes sense. So random and systematic and MUS seem like the more robust methods generally.
often, yes, especially for statistical approaches. The key is choosing a method that fits the audit objective and gives you a sample you can reliably draw conclusions from.
Well, this has been really illuminating. We've gone from the nature of estimates in ISA 540 right through to how auditors select samples to test them. Definitely clarifies the auditor's role with these uncertain numbers.
Absolutely. It really highlights the need for professional skepticism, solid risk assessment, and just diligent evidence gathering. It's not simple box ticking.
No, definitely not. So maybe a final thought for you, our listener, as you digest all this. We've talked a lot about uncertainty, judgment, assumptions, bias, all in the context of auditing financial statements. But maybe chew on this. How often do you encounter similar situations, estimates, projections, uncertain information in your own work, or even personal life?
That's a great point.
Thinking about the underlying assumptions, the potential for bias, the level of uncertainty, maybe applying that kind of critical lens we discussed today could be useful far beyond just reading an audit report.
It really could. That skill of evaluating information critically, understanding its limitations, it's pretty universal.
Indeed. Well, thank you for sharing these sources and joining us for this deep dive. We hope it sheds some light on the intricacies of auditing accounting
I
estimates.
hope it was helpful.
As always, think about what new questions this sparked for you. Where might you want to explore next?
Yeah, keep digging. There's always more to learn in this field.